We saw the stock market crash after President Trump announced potentially 100% tariffs on China about a week ago, and the end result of this was the market saw its worst day since April, which was also when President Trump was threatening tariffs. So if we look at the S&P 500 performance over the last month, we can see right here. Here was the major dip. Now, the market has recovered some since this was announced, but if we look at the heat map of the S&P 500, we can still see there's quite a few sectors deeply in the red in the last week, particularly sectors like technology and healthcare as well. And again, despite the market doing really well over the last 3 years now, the CNN Fear Greed Index is now teetering closer to extreme fear. But in the midst of all this chaos, I actually added capital to 3 existing positions in my portfolio, and I also added capital to an entirely new position. And one of these companies you could certainly say that I just bought the dip on. Now, buying the dip is a term we hear pretty frequently, but I also think it's where a lot of people can make mistakes. For example, if we look at the S&P 500 now over the last 20 years, yes, the performance has absolutely been amazing, but look at what's been going on with the PE ratio overlaid over the stock price during this time. Yes, there's been a lot of earnings growth in the last 20 years, but as we can see here on Forecaster, there's been a lot of multiple expansion as well. The PE ratio is now sitting at about 27.2 for the trailing 12 months. So with valuations going higher, we absolutely want to make sure we're buying stocks at reasonable valuations that can continue to grow their earnings in the future. So when we talk about actually buying the dip, as this image portrays, we want to avoid the damaged companies, the companies who have stock prices going down because earnings and revenue are declining. But what we do want to do is buy damaged stocks where the stock is going down, but revenue and earnings are still going higher. And that's exactly what I believe I have done in the last week. The new company that I just added to my portfolio is S&P Global. Now, if we scroll down here on Forecaster and look at this company in the last 5 years, the performance has been somewhat substandard. They're only up by about 40% when you don't include dividends. So while the share price has certainly been choppy, we can see sales every single year have continued to grow at a very healthy rate, and the same is true with the dividend payments as well. And this is one of the cool features of Forecaster.com, which, by the way, there's a link to down in the description. You can overlay the fundamentals with the stock price, and it essentially allows you to see whether you're buying a damaged stock or a damaged company. Now, if we take a zoom in on S&P Global, we can see in the last month, now down by over 10%. That's a pretty rapid sell-off for a stock like S&P Global. And this was a company that I had had on my watch list for a while. Now, what's interesting is if we go ahead and zoom back out a little bit, let's look at the last 3 years. Yes, we can see the share price has followed sales growth. The share price has been following net income growth, but look at what's been happening with the PE multiple. We can see in the last year or so, while the share price was climbing, the PE multiple was falling. How is that possible for the stock to climb without the PE multiple going higher? Well, it's simple. It means that earnings are growing at a healthy rate. And you can see that's exactly what's been happening for this stock in the last 3 years. Earnings have grown at a very nice rate. In fact, if we just go ahead and jump over to the fundamental tab here on Forecaster and scroll down, we can see in 2020, sales was about $7.4 billion. 2024, it essentially doubled all the way up to about $14.21 billion. The same is essentially true with net income as well. And one of the things we have to make note of, the growth has been incredibly stable for S&P Global. Unlike a lot of companies during 2020 who saw a massive drawback in their fundamentals, S&P Global continued to grow at a healthy rate. Now, the question is, why is that? What is the company's business model that allows them to grow cash flows at such a predictable and healthy rate? And this is exactly what I was talking about over on Dividendology.com just the other day. S&P Global provides essential financial infrastructure, and they have 4 main business segments: S&P Global Ratings, S&P Dow Jones Indices, S&P Global Market Intelligence, and then Global Commodity Insights and Engineering Solutions. But what really makes this company so attractive is the predictability of the cash flows. As of 2024, around 95.9% of the company's revenue was recurring in nature. This is the exact reason that we see sales year after year continuing to grow. It's because the majority of that revenue is recurring. It's going to be coming in year after year. And on top of this, the business is incredibly capital light. Look at the free cash flow margin. In 2024, it was 39.17%. So basically, for every $100 in revenue the company generates, about $39.17 became free cash flow. Now, that's quite a bit better than the last couple of years. So we're seeing revenue growing and we're seeing margin expansion, which is a great combination. Now, looking at S&P Global, we can see this is a low yielder. The starting dividend yield right now is only about 0.78%. Now, we do have to ask ourselves, what was the reason for the 10% sell-off in the last month? It wasn't purely due to President Trump's tweets. Well, if we look at the Forecaster AI agent and look at the company's competitors, one of the competitors that you'll notice is going to be FactSet Research Systems. And they released their latest quarter's earnings not too long ago. And basically what spooked the market was the fact that they issued lowered guidance. And that's the exact reason that we're now seeing the stock trend towards its lowest PE ratio in the last 3 years. Now, for me personally, I don't have a huge focus on technicals, but if you look at how the current year's been performing versus the last 5 and 10 years on average, you can see the sell-off has been pretty radical compared to how the stock has historically traded. So what exactly did my S&P Global purchase look like? Well, we can see my S&P Global purchase here. I bought 10 shares at a purchase price of $487, so it's an investment of $4,870 with a dividend of about $3.84, adding about $38.40 to my annual dividend income. On top of this, we can see the 3 other positions already in my portfolio that I added capital to: Texas Instruments, Visa, and MPLX. Now, Texas Instruments is a very unique situation because if we look at them in the last 10 years, they've outperformed the market, but in the last year alone, they're down by about 12.67%. Now, here's what's interesting. Look at the last 10 years. Look at the stock price versus the net income. The stock price has remained in this choppy range here while net income has declined dramatically. So at first glance, it looks like we'd be making a mistake buying a company that's declining in share price because it's a damaged company where revenues and net income is declining. But you have to understand the full picture for Texas Instruments. Texas Instruments is currently going through a period of elevated capital expenditures. Why are they doing this? Well, they're doing it to reduce costs. And at the end of this period of elevated capital expenditures, they expect gross margins on this particular product to go from about 60% to 68%. That's a dramatic improvement. So right now, if we look at the fundamentals for this company, it is concerning at first glance. You see sales declining, you see net income declining, but management highlights in their earnings report why this is and what we can expect moving forward. What we're seeing charted out right here is Texas Instruments free cash flow per share. And right here is their planned period of elevated capital expenditures. Now, what they're projecting by 2026 is free cash flow per share could get back in the range of maybe around $8 to $11 per share, which would be a dramatic improvement from where they were even in 2021, which is the highest it ever was. So this is certainly a stock where the fundamentals are very deceiving right now, because the share price has essentially gone nowhere in the last 5 years, but net income has continued to climb, and at the same time, the PE ratio has continued to climb as well. But remember, the PE ratio is higher because earnings are lower right now. Investors are still buying with the expectation that earnings could be growing at a high rate in the future. Let's also keep in mind that historically speaking, Texas Instruments has been a phenomenal dividend growth stock. Back in 2009, paying out about 11 cents per share and now $1.42 per share. And buying in right now would give you a starting dividend yield of about 3.1%. So buying Texas Instruments is definitely a bet that those capital expenditures is going to pay off. Their management team seems to believe that will be the case. Then on top of this, we have a little bit of capital added to Visa, bought at a purchase price of about $344 per share. When we look at Visa charted out over the last decade, it really is a thing of beauty. We can see the stock is up about 354%. If we look at net income overlaid, you can see why. Earnings have grown dramatically in line with sales, in line with the share price, and they've been growing those dividends as well. Now, here's what's interesting is if we look at that PE ratio, for the trailing 12 months, it's sitting about 33.7. Obviously, it's quite a bit lower if you look at it on a forward-looking basis. But this is a company that's no stranger to trading in those higher PE ratio multiple ranges. And to put it quite simply, when I look at this company and look at earnings growth projections and look at how the company's currently positioned, I continue to believe that they're going to be growing revenues and net income at a very healthy rate in the future. So when I think about my personal portfolio and the long-term goal to be able to one day live off dividends, I think Visa still absolutely makes sense. And then finally, the last addition was MPLX. I added another 40 shares, coming to a total amount of about $1,920, and that actually added about $153.20 to my projected annual dividend income. So the total capital invested was around $8,338. Dividend income added was about $224.72 from these 4 purchases. Now, MPLX is dramatically different from these other companies. If we just look at the starting dividend yield, Right now, it's sitting at about 7.76%. So this is a high yielder. I don't own a lot of high yielders in my personal portfolio, but MPLX is quite unique. We have to remember this stock is an MLP, a master limited partnership, and it actually overcomes a lot of the challenges that I think typical high yield stocks see and typical energy stocks see. For example, when we talk about MLPs, we want to pay attention to their distributable cash flow. This is the key metric. It tells us if they're going to be able to continue to sustain and grow those dividends. Well, they've been growing this at a rate of about 7% over the last few years. That's very healthy. And so as a result, they've been growing their dividends at a very high rate. In fact, a compounded annual growth rate of about 10.7% over the last few years. That's mind-blowing dividend growth for a company like we just saw that's already yielding close to 8%. Keep in mind this company has healthy distributable cash flow coverage of about 1.5 times. And the statement that management recently made in their earnings report is quite exciting for shareholders. They stated, "We see a period of time where 12.5% is very doable, and that's in regards to dividend growth. It's tough to give you an extremely long horizon, but we certainly are trying to convey to you that distribution growth at 12.5% has the potential to be durable for a period of time." So we're talking about a company yielding close to 8%. That could grow dividends between 10 and 12% over the next couple of years. It's extremely difficult to find many stocks that are in that exact same scenario. Now, one other thing to note is I have stated before how I'm not typically a huge fan of energy stocks or oil stocks in general. But again, MPLX is a little bit different. They generate much more stable cash flows because most of them are fee-based that are protected by long-term contracts and minimum volume commitments. So essentially, their cash flows are less sensitive to commodity price swings compared to other traditional energy producers. And if we look at the fundamentals, you can see that's exactly the case. When you look at most oil stocks, you'll see sales go way up or way down depending on what the price of oil is doing, but MPLX continues to grow revenue and distributable cash flow year after year. So those are the 4 buys that I made when we saw the market dip. We have to remember, not all dips are the same. Some can be massive opportunities when the fundamentals are growing and the share price is declining, but some are definitely mistakes to avoid when revenue and fundamentals are declining. And fortunately, Forecaster.com does a great job of overlaying the fundamentals with the share price so you can see exactly what's going on. Again, there's a link to Forecaster.com down in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.